Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello friends, this is Vijay Bhambwani, and in this video I'm going to basically tackle a query on something that I feel is on top of the mind issue of almost every trader and investor in the market. Should there be a specific strategy very different from a usual peacetime strategy now that we are witnessing war in Eastern Europe? Is there something different that you need to do in this market as compared to usual times that you have seen in the 3 quarters of 2020 and maybe almost all 4 quarters of 2021? Well, the answer is a yes. You see, markets are like a military strategy. Almost always there are some nasty surprises all along the way. And it is the job of a trader that he has to be alert and remember the 2 things that I keep talking about in my videos. Number 1, nothing happens in financial markets without a reason, and since these are financial markets, the reason itself is financial. And number 2, we traders are brain warriors. We win or lose with our brains, with our ideas, and the money that we deploy in the market are our chess pieces. The market itself is like a chessboard. So you need to keep shuffling your money from one square to the other so as to get the best possible returns. And there will be times when you need to just pull back a little, go on the defensive, and think of capital preservation rather than capital appreciation. Look at it this way. Sometimes you might just need to take a step back so that you can take 3 steps forward. So, is there something different? Yes, and I'm going to go through it right now in this video. Bear with me in the next 5 minutes. I'm going to share my strategy of what I have learned in the market over the last 36 years that I have been trading these markets. First and foremost, do not discontinue your SIPs or systematic investment plan. Because as you keep allocating, say, hypothetical figure of 5,000 rupees a month, you will basically acquire more and more securities, whether it is a debt fund or a equity fund or it's a balance fund or whatever it is. You will keep acquiring your units at a price which will be a better average as compared to what you were holding a couple of months ago, because then you are able to buy at discounted prices as compared to the past. So do not discontinue your SIPs. The second part is, in these times, nerves are extremely stretched. Traders are nervous, they are running helter-skelter. Leverage traders are busy arranging mark-to-market pay-ins for their brokers, because unless they make this mark-to-market payment, what is known as margin call, the brokers are going to cut their trades off and make them book losses. So, typically speaking, the biggest falls are recorded by those stocks which have very high beta. Beta is statistical volatility. You must avoid those counters at all costs, at least during turbulent times. By the way, these counters can actually be very good trades during normal market times, but during turbulent times, you need to drop them like hot potatoes. The other aspect is, choose those stocks that have a very high relative strength comparative reading. Now, what is relative strength comparative reading? I'll explain to you. And this is it's a study, a metric, which is available for free on almost all free charting websites. You can get it on TradingView, you can get it on investing.com, you can get it on chartview.com, XYZ. Like I said, almost all free charting websites will have the relative strength comparative. Now, I'll just run you through what it actually means. So here is the Nifty, here is the stock ABC. Okay. Now, a high relative strength comparative would mean that when the Nifty rises 1%, the stock rises more than 1%. When the Nifty falls 1%, the stock falls less than 1%. Is it possible to have a statistical reading on this? Yes, it is. That is what these websites and charting softwares provide you. So let statistics come to your rescue and weed out all the stocks which are low relative strength comparative and rope in those stocks which are high relative strength comparative. And the best part is that you're going to get those high RSC stocks at lower prices during market nervous phases. So when you add two securities in technical analysis software and then tell the software to deploy the RSC or relative strength comparative, it will tell you what is the strength of one security versus the other. If you're taking stocks, the best comparative benchmark would be the Nifty. If you're taking commodities, the best benchmark would be gold. If you're taking bonds, the best benchmark would be the Indian 10-year sovereign benchmark yield. If you're basically taking currencies, then I think the Dixie would be a fairly good benchmark of relative strength comparative. So now you have the metrics for all four asset classes: equity, currency, commodity, and bonds. Allocation of your money is a very key aspect. If you scroll down in this playlist, you will see that I have recorded a video as to how much money should a trader or an investor deploy in the market. I've given you a metric. It depends on your age, and you can, if you are a very conservative person, you take a figure of 75, which is the end of the cycle, a commercial viability cycle of an average working person, and deduct your present age. So for example, I'm 56 actually. Okay. So if I'm a conservative investor, I would say 75 minus 56, I get 19. So 19% of my capital is what I should put in high risk investments, which is equity, and the others should be in low risk investments, which is fixed income, bullion, real estate, etc. What if you're not really high risk? You want to play the a little more adventurous type of a game. By all means, take it to 90 or even 100. Some very aggressive traders I know use 100 instead of 75. So at 56, if I'm a very aggressive trader, I would say 100 minus 56. So 44% of my wealth would be in high beta investments like equities, and the remaining, of course, would be in sovereign investments, bullion, and real estate, etc., etc. But asset allocation is a key. And if you've noticed something, in Diwali, my New Year picks, the new Samvat year picks, was the Nifty 50 and the Indian 10-year benchmark bond for the next Samvat year. Sure enough, I got a few wisecracks as comments. Please do keep them coming. I don't take it hard at all. Somebody said, hey, why don't you start recommending the new pension scheme if you're that old, if you're that risk averse? Look, I'm much better off not suffering those whipsaws of ups and downs in the market, and yet from Diwali to now, my sovereign fixed income investments have still yielded positive returns. So has bullion, whereas equities, you can't really boast of that. So it is better to have asset allocated. I have in my past videos said 20% of your wealth at least should be in bullion. And depending on your risk appetite, and which of course will be fluctuating with age. So I've given you a metric, 100 minus age or 75 minus age, depending on whether you're low risk appetite or high risk appetite. And so 20% ballpark should be in bullion. Depending on your age, a minimum of 15 to 20%, if not higher, should be in fixed income. And as I've told you in the past, I prefer sovereign investments, and I've recorded ample number of videos and I've given you ample number of avenues. For example, The Reserve Bank of India's RBI Retail Direct GSEC Access is a superb and fantastic platform where you can deploy your money in 100% government guaranteed bonds without paying any brokerage or any middleman's charges at all. The trading is free, and you basically are buying something that is backed by the government of India. So, asset allocation. Then, on Equity Master, I wrote an article for their website which was dated 12th November 2022, the hyperlink to which is in the description below this video, and the title of that article was "A Veteran Trader basically digs into the market." And the article was all about what is driving the market currently. Remember, it was written on 12th of November 2021, and what the trader expects, that was me, expects in 2022. I have very clearly written in November 2021 that I expect 2022 to be a relatively poor year for equity investors and traders, and there will be many myths, many misconceptions, and many dreams that will get shattered in 2022. I frankly did not have any inkling of a war, but there was very clearly some signs emerging that market was being subject to some excesses. Do make it a point to read that article. And the one thing that I have told you very, very clearly is that the average age of a trader has fallen very, very sharply. As a matter of fact, a leading financial television channel had done a study wherein it was found, thanks to Aadhaar and PAN cards being listed, connected to all brokerage and demat accounts, that 4 out of 10 active traders in India today are under the age of 30. And in that article, I wrote how the young people are extremely gung-ho. They want money to be made quick. They want quick returns, and therefore they latch on to thematic stories. Thematic stories are basically short-term stories, something that's like a fad, those long Elvis Presley kind of sideburns or bell bottoms. You can't treat that as a fashion trend. You have a theme party. People want to dress as Dracula or the best Zorro or the best Phantom costume. It's not something that you're going to go out there and wear every day out on the street. So it's just a theme. Now the point is that younger traders love thematic stocks because they give superlative, supercharged returns. But the problem is that those returns remain for very short periods of time. Thematic stories get extremely, extremely severely punished during war times. During war times, people basically go risk averse. They pull their money out of aggressive thematic stories and go into the tried and tested long-term solid companies. And not just companies. We are not talking restricting ourselves only to equities, but they again go back to flight of safety of gold. Now, gold is something you are seeing on my videos fairly often all through 2019 and 20. 19 and 20, nobody was complaining, but when I gave out targets of 85,000 levels on silver and 65,000 levels on gold, for my friends who are watching from overseas, in gold I'm talking about Indian rupees for 10 grams, whereas silver I'm talking about Indian rupees for 1 kilogram on the MCX. There was obviously a little bit of peeve on behalf of some of my viewers that, hey Vijay, gold is not really doing too well and we are tired of holding it. Obviously there were some displeased investors, but look at yourself now. You're sitting on top of profits, even as equity traders are basically chewing their nails off in tension. So like I said, investments and trades are like a military plan of action. Nothing really goes as per plan, as per blueprint. You will keep facing some kind of unexpected surprises, and more often than not, they will be nasty in nature. Stick to your course, stick to your core beliefs, and keep adjusting your portfolio. Remember, you're a chess player. The money that you're deploying in the market are your chess pieces, and the market itself is a chessboard. Keep shuffling your chess pieces across the squares on the chessboard, and you'll be just fine. We've seen wars before, we've seen calamities before, we've seen a whole lot of adversity to the stock markets before. It takes a while, it takes some time, but markets invariably bounce back. On this cheerful note, my friends, I bid goodbye to you, not before reminding you to click like on this video if you liked what you saw. In the comment section, good, bad or ugly, do let me know your thoughts on this video and what you would want me to record in my next. Click on the bell icon to receive instant alerts about fresh videos being put about here. And please help me reach out to fellow like-minded investors and traders by referring my video to your family and friends. Do take very good care of yourself, your health and your portfolios. This is Vijay Bhambwani signing off for now. Thank you for your patience till we meet again in my next video. Bye-bye for now.